publish financial statement which is giving you accounting profit which can be different from the economic profit. What is the difference between economic profit and accounting profit? Accounting profit is computed as per GAAP, and their dividend is not an allowable expenditure. Dividend is a reward for capital, but then that is not allowed to be taken as an expense. So to that extent, you have to compute an opportunity cost of capital, the imputed cost of capital. Then only you will be finding the true economic profit. So that's an inherent limitation of the accounting data, and ratio analysis suffer from that. So you need to find other ways to really find the imputed capital and then use that. So that will not come from the accounting data. So you will not have that kind of information from the accounting data. So purely based on accounting information, ratio analysis will suffer from all the limitations of the accounting profit. That's it. And then another issue with the accounting profit is that the management will always try to manipulate. There is an incentive to manipulate the financial situation. Like if you're worried about the income tax, then you will try to understate the profit so that you pay less tax. So the ratios computed based on that will not be correct. Similarly, if you are a public company, the management's single most objective would be to maximize the shareholders' value, right? So that means to maximize the market capitalization. What is market capitalization? The number of shares into market price per share. Right, when the prospects of the company is really bright, then only the market will value the company in the right, favorably, right? So you should have high accounting profit, so you will understate all the expenses, you will try to exaggerate the income. That's the nature of the accounting profit. So if people are trying to window dress the financial statement, window dress means trying to give a rosier picture than the actuality, then the ratios also would be affected. It will not really give you the correct information, right? So the common areas for the accounting profit to be wrong is they will try to overstate the sales, right? So you have to really see whether they have followed the correct cutoff, whether the goods are delivered, all the risk and rewards are transferred from the seller to the buyer. All those things are there. So, but still the companies can really go for manipulating, because there is actually a good correlation between the accounting profit and the share price performance. That's not the only thing which can really affect, but then that is one of the most important input as far as the share price performance is concerned. You go for fundamental analysis, the company is more profitable, then the share price would be higher, right? So there is a motivation to overstate the profit. And I wanted to say something, I forgot. Yeah, what I wanted to say is, see, like if you are a listed company, there would be many analysts who would be giving the profit estimates, right? If you are publishing a profit less than the analyst expectation, there will be a lasting impact for that as well. Meaning, like your share price would be adversely affected for quite a long period. If the analysts are giving, say, a projection that the company would make a 1 million profit in this quarter, the company is making a profit of 1.5 million, upside potential, nobody is worried. But if it is less than 1 million, then the company failed to meet the analyst expectation. That is what the financial press would say. They will not say that the analyst has gone wrong. Instead, they would say that the company failed to meet the analyst expectation. So there is a pressure on the management to meet the analyst expectation. So what will they do? they come across an incidence of a bad debt which can really pull down the profitability below the analyst's forecasted profit, they will try to cover it up. They will try to take the provision in the next accounting quarter. So that can be affected. So that can affect the true profitability. That can affect the quality of earnings. So there is a motivation on the part of the management to manipulate. If they are concerned about the taxation, they will understate the profit. But most of the cases, the listed companies, they would try to make the profit rosier than, or the financial situation rosier than the actual. So then it's the other way around for such companies. Then now I have given you a clue about window dressing the financial statement, right? How do they do it? If there is a button, they will not take provision for that. They will understate expenses and overstate income. So that's the way they window dress the income statement, right? But there are like, in the same way as they window dress the financial statement, they have incentive to do that. I've explained to you that. There are like techniques to window dress the ratios also. If you remember, I told you how an average, a normal ratio would behave, right? See, normally some key ratios are very pertinent. Like one is current ratio. All the lenders will look at the current ratio. Normally for a company it is greater than 1, right? Ideally current ratio has to be greater than 2 if you are approaching a financial institution for a loan, right? And debt equity ratio, similarly the lender would specify that, right? Like that, some key ratios are there. So these ratios, the management has got an incentive to window dress these ratios. So let's take this current ratio. The company is at 1.9 current ratio. Current ratio is a multiple, right? 1.9 is, but you need 2, right? So what should you do to improve this to 2? It's a great ratio greater than 1. So you know that if you reduce the same number from the numerator and denominator, if you reduce the same number from the numerator and denominator, the ratio will always improve. Ratio will behave in the opposite direction, right? You should reduce the number from the numerator and denominator. So say if you are like, just look at the balance sheet, you normally pay the salary at the beginning of the next month. Because you have seen 1.9, you can do a slight window dressing by paying the salary now instead of paying on the first day of the subsequent year or the subsequent month, right? So you will have the cash coming down from the numerator and current liabilities coming out from the denominator. So then the same number coming from the numerator and denominator will increase this ratio, because the ratio is already 1.9 greater than 1, so you can window dress that. So it is like you are window dressing the financial statement, you can window dress the ratios also and adhere to those ratios, the stipulations by the lender. So you should be careful about that, right? Then development of ratios for comparison with industry average is more useful for firms that operate within a particular industry than for conglomerate. I have told you that as such. So you can really look for the companies in the same industry, but the ratios for Wipro, if you take, then it may not be really comparable with any company, because Wipro is there in consumer products, Wipro is there in the technology sector. So you need segmented information. Other than that, the ratio analysis may not be of interest. And then you are actually, when you develop the comparison, again you have other concerns, like the industry average may be based on not so representative of the industry. They may be computing industry average based on not so representative of the industry as such. They may be taking some one or two big companies and then giving out as industry average. So that kind of danger is there. And then your company may be too small or too big to really compare with the industry average. That can be there. So all those issues are there. And then when you take the comparison from one industry to another, you should ensure that the ratios are computed using the same formula. So you should really see what formulas they have used. If you buy the information, the comparative information from people like Standard & Poor, the rating agencies normally give out this information. Who are the most famous rating agencies in the world? Like the accounting firms you see, Big Four, or that, like that. In the rating agencies, Standard & Poor is a very known rating agency. Fitch Ratings is a very known rating agencies. And then what is it actually? Standard & Poor, Fitch, Moody's Ratings. Moody's Investor Rating is another thing. These are the biggest three in the rating agencies in the world, right? Among the rating agencies. And then of course, if you take the Europe region, then you have Capital Intelligence. In India, we have CRISIL. So these people publish and then another like other private agencies like Robert Morris Associates, Bloomberg, Reuters, they all publish the comparative financial statements with the ratios. So you have to really see what formula they have used. If they have used a different formula, you have to really tweak your data accordingly. So you have to really see that you are comparing like to like, right? So that is it. And then earnings quality I have touched upon. Right, I will come back to the earnings quality. Let's see what all things are. Okay, I will go in the order of this textbook. See, what is earnings quality? Earnings quality is a measure of how useful the reported earnings are as a performance indicator. How useful means like how much reliable this earnings to forecast the earnings for the future. There, in the finance parlor, you are not worried about upside risk. That is rather called an upside potential, not upside risk. Whereas the forecast turning out to be less than what you have projected in the case of profit is the risk. So companies following conservative accounting policies will have better earnings quality, right? Say if you are making so much estimates, no depreciation, then bad debt. So in all these things, if you are making conservative estimates, right, then you to that extent the quality of earnings will be higher. That you can end up having a better profit than what you are projecting. That is one. Another thing actually, like some accounting principles are will give you the conservative profits. Say for example, in a rising price scenario, inflationary scenario is a general rule than deflationary scenario. Deflation rarely happen. Inflation almost surely happen, right? Then in an inflationary financial scenario, FIFO will be having less earnings quality than LIFO. That means LIFO will have the highest earning quality. Why? Because LIFO based inventory accounting takes the latest cost. Latest cost is always higher. As long as the business is growing, right, you will not have LIFO liquidation. So that means the case actually you will have the latest cost coming in the income statement. So that will be a very conservative profit. That means your cost of goods sold will not be understated if you follow LIFO. So you are really having more earning quality if you go for LIFO. So you should understand, you should really think that way. The less profit or the higher cost of goods sold, meaning you are having better earnings quality. Your projected profit will not be less than the historical profit. If you take the historical trend and project, you will be safe. Right? That's about the FIFO. Then let me take one company is following straight line method, other company is following declining balance method. during the initial period, uh, the company following declining balance would have already taken a bulk of the cost as depreciation. That means their future would be always brighter than a company following straight line. So straight line method is having less quality of earning than the declining balance method. Or in other words, declining balance method will give you better earnings quality than the straight line. So two statements you can remember. In the case of inflationary situations, LIFO will have better earnings quality than FIFO, right? And comparing to the other methods, declining balance method of depreciation will have better earnings quality than the other methods. Straight line method will be equally giving that. So obviously declining balance would have taken more expenses already. So the historical profits as an indicator of future, you would be safer to use, right? And then when you are taking the earnings before interest and taxation, some of the companies may be having a different debt in their capital structure, different proportion of debt. So if you have to take the earnings before interest and taxation, compare with the capital employed, compare with the assets, total assets invested in the business, then it will be having a more consistency, right? So the earnings quality will be better if you use that earnings power, earnings before interest and taxation. See, just adding back interest will not be helpful because interest is really distorting the taxation also. So you have to take earnings before interest and taxation to really see the earnings power of the company, right? Then I had some other point in mind. That will come to. So you have the earnings quality as your concern, so you know how to make. Yeah, this is what I wanted to say. Like, you are talking about, when you talk about earnings quality, you are talking about predictability of the future profit. Certain industries are having less earnings quality than other industries. Say for example, if you are an investment company, by nature in 1 year we see investment banks and investment companies, financial institutions in that particular industry, investment banking and all, like you will be having some huge investments and some of the deals may go wrong, and then during that year you may be having a high loss, but another year you will have this kind of fluctuations in the profit in certain industry. Definitely you will not be able to predict the future when you have high amount of variability compared to an industry which has got not so much of fluctuations in the earnings. So you should really be happy to analyze a company having a stable line of business and a stable profit as a percentage of sales or as a percentage of the asset size. Then those companies and those industries are having better earnings quality than companies are having widely fluctuating earnings. So this fluctuation in statistical terminology, how do you find the variability? Like you have the measures of central tendency, mean, median, mode, all those geometric mean, harmonic mean, these are all like how much would be the expectation you will get. Arithmetic mean is the best measure of central tendency. Similarly, how that measure of central tendency is varying, then you need standard deviation. So when you have the historical data, standard deviation, the less standard deviation, the better earnings quality, right? You can plot that in a normal distribution and see with 5% level of significance or 95% confidence limit, this much would be the profit. So normal distribution can be used to really measure the earnings quality, because standard deviation and then how the mean is varying from the standard deviation, that is what is really coming there. So you are developing statistical distribution, and whenever you don't know the real nature of the distribution pattern, if you have a large sample means more than 30 sample size, you can always assume normal distribution. That is way to really go compute predict the model with statistical level of confidence and level of significance. Then there is another concept taking the standard deviation further, like value at risk models like VAR. Here then you will really see the fluctuations in the returns, the profitability, and with the historical information and volatility. The less volatile, the more would be the earnings quality. Value at risk, cash flow at risk, these are concepts which you will be learning in other topics, right? But you should really see that the variability is risk. So you are trying to analyze that and then come to the conclusion regarding that. So you may need advanced statistical concept when you talk about earnings quality. So your accounting policies, FIFO, LIFO, straight line method, all those things affect the earnings quality, I have explained. And now another small point, when you are really having the industries affected by seasonality, then you should be knowing that the average beginning balance plus ending balance divided by 2 may not be really reflective of the average position during the year. So you need at least the quarterly average, but if you can get hold of the monthly averages, it would be better. But certain industries, even daily average would be needed, like financial institutions, to find the cost of funds percentages on that. So ratio analysis is affected by seasonality, so you need more involved average to really take care of this thing. And then comparison between the geographical regions and all will be distorted by the taxation impact, the availability of labor, all those factors really affect, so you should be knowing about that. So now we have 2-3 minutes, so ratio analysis may be applied ineffectively, ratio analysis may be distorted by failing to use an average instead of this thing or weighted average. Different sources may compute ratios using different formula. Then like you will have different ratios may yield opposite conclusions about, so you need the net impact, like if you have read the Jataka, like horoscope written for some infants, babies, you will see because your tree is this, these are the qualities, because your animal is this, oftentimes it is conflict, so you have to really go for a conclusion out of the conflicting result and the conflicting ratio indications. So that is the thing. Then you will see some of the ratios like profitability ratios. In pursuit of profitability, what you're trading off is the liquidity. So you will have to really see a trade-off between profitability. So you cannot really see any conclusive stand just based on one set of ratios. You have to really see the other ratios also. So I think we have even gone through the ratios to the extent it is needed. But then of course part 2, one danger is that in the ratio analysis you may even have like the examiner may really indirectly would be, you would be as a candidate, you would be requiring to have some kind of knowledge like merger and acquisition, like all those things. So you may be given price earning ratio, and the earnings per share. So price, you will be see how many shares you have to issue further. If you are acquiring a company, how much would be the resultant EPS? This kind of questions will be coming. So you have to have a good amount of common sense also to really score well in that. I said common sense, not really the knowledge of other topics. If you are having a good amount of common sense and then a general understanding about economics and commerce, you should be in a good position. But again, you are learning so much of that basic knowledge in the other sections of part 2 itself, so don't worry. If you really go through the questions in the claim, you will be in a good position. So go through all the questions. Subin especially may not be there in the next class, so you go through all the questions. For others, please start practicing your claim software. If you haven't started, you have to go for custom option and you have to activate your software and start using that if you haven't done that. I will go through in the next 1 or 2 weeks your software performance, and I will come back to you with my feedback. I might even give you a test in the next 2 weeks whether you have understood this section or not. Now it's time. Study well. Subin, all the best.